Good evening, everyone. I hope everybody is good today. I'm still recovering, but I will be able to deliver the lecture today. And guys, before I start the lecturing, I would like to make some bit announcements that I made bit changes in syllabus to make it more practical and scientific oriented. And I want to not just to get some information related to the risk management and just pass the course and get graduate, but I want you to learn it and get really good benefits from this course. And the changes I made it, like for syllabus, I changed like 40% of the content, but I added some book and added some software that you will be using to do some analysis. The software that you're going to use is called Stata. Maybe some of you already heard it. It's a statistical econometrical software that have been used by statisticians and economists to do some empirical analysis. And to get this program, I will share the link with you a bit later so that you can download it and you can use it. It's a free of use, but basically it's not free of charge, but for this time, for this course, you will get a link that you can easily download and use that free of charge. So that the program is called Stata. But let me share the screen with you now. I'm gonna let me check whether I have it in Moodle or not in L Drive, because I didn't have a chance to get it. So for Stata cases. No, we don't have it here actually. But maybe here. No, here. No, it's not here. But I will put it in L Drive. You can download from L Drive that program, Stata. How it looks like, I will show it to you now. The program itself. It's called Stata 15. You just press click on it. Start, double click on the, and the program starts like this. Okay. There is a command that you should give and you should run the program and so on. I will teach you how to use this program. I will teach you some codes, some commands as well to use it to do the empirical analysis. It's going to help you in if you're planning to do the master, if you're planning to do then later PhD, it's going to help you a lot. Use this program, like to be I'm making you to be prepared to be a young scientist. Young scholars. Okay. And what changes I made it in syllabus? I simplified the work. I don't want to complicate your job because of the distance education, and it's really difficult. I understand that how much difficultiness it created for you to study by your own, but I try to simplify as much as I can this course actually. So what I made it, I'm just gonna share with you the syllabus as well, the changes I made it, but I'm gonna upload it into. Oops, it's not that one. So unfortunately, it's not in here, but I don't know. I have to search. Let me not spend the time in here, but I'm going to share with you this definitely on Wednesday, this updated syllabus, and it's simplified more like we're going to deal directly with the risks that the financial institutions they face and how they manage those risks. And you will be given a certain project. You will deal with that project, okay, using the Stata program. We're going to talk about it, but it's going to be easy project, and at least it will give you a direction how to write scientific papers, how to write the scientific articles. No. In the exam, if the starter project will not be included in the exam. It's a separate, okay? It's separate. It's not going to be included in the exam. Exam questions will be calculation based from the chapters that we're going to proceed with, but the starter will be separately projected, okay? It's not going to be included in the exam. Okay. Okay, the last time I give you the activity, to do the activity, and I would be very happy if somebody will share the first question with all of us and explain it. How you did it. I want you to try it, to explain it, to get it well, and to make sure that you really understood everything. Question number 1. Like, information is given here, and what is the expected return and standard deviation returns? Is there anyone who can share with us their solution and so on in Excel calculation?
Well, I can do that, I guess.
Okay, Tanger, I will be very happy. Please, I'll stop sharing and I'll let you to at least go 2 questions. Okay, they're related, first and second. Go
All
with
right.
it. Okay, stop sharing. Just share the screen.
Wait a second. I need to change my system preferences.
Okay, change it. Change it. So meanwhile, while you're changing your system preferences, I want to underline that I will be using some CFA book as well, some information from CFA book. They are very good information related to some investments.
Can you see now?
Yes, we can see it very good.
So yeah, this is the first question activity. So basically what it says, the investment has probabilities of 0.1, 0.2, 0.35, 0.25, 0.1. And the returns are 40, 30, 50, 15, 5, minus 15, yeah. So we have basically a formula that I used, that I saw in your Excel file. So we take these probabilities and we multiply them by their equal return. Wait. So 0.1 multiplied by 40% plus 0.2 multiplied by 30% plus 0.35 multiplied by 15%, etc., etc. We get 12.50%. For the standard deviation, we do almost the same thing, but we raise it in there's a book that to the power of 2. Yeah, and then we take the 12.50%, which is expected return. We make it in the power of 2 as well, and just multiply it. Yeah, just add it and then how to say, add it and then
Subtract.
Yeah, subtract 12.5 in the power of 2. We get 17.07%.
Okay.
Yeah. So for the question 2, well, in the textbook, there's a wait. In the problem 1.1, yeah, we take the problem, and we have equal weights of 0.5. So basically 50-50%. So we multiply by expected return that we got in the first question. So, and we get 12.50%. For the standard deviation, we take both equal weights of 50%. We multiply them by 1707, which is standard deviation. But first we need to get the value of 0.5 in the power of 2. So we add this together. We also have a correlation between the returns is 0.15%. So we add it and multiply it by equal weights and by the standard deviation, and we get 12.94%. So yeah, something like that.
I have one question to you.
Yep.
Why you didn't take the square root of this?
Of 1707, yeah?
Yeah.
I guess I made a mistake, yep. Yeah.
No, the whole, like this standard deviation.
Yeah.
The whole, this calculation, it should be taken to the square root of it, the whole numbers. Like 0.5 to the power 2 times 17072 to the power 2.
Oh yeah, I get it.
I mean, these whole numbers should be squared root.
Uh-huh.
And the same thing should be done with first question.
Yeah, but I guess I did it in the first question, but I haven't done it in the second one. Yep.
I mean, not raising to the power, but taking the square root of it.
Okay.
Do you know what does the square root of mean?
Yeah, I get it.
Okay.
Yeah, I get it. Okay. Oh, I get it. All right.
Okay, there's a book. In the book, there is a the equation. If you go to that equation, the page is 3.
Yeah, may I stop sharing the screen?
Yeah, I can share the screen. Wait, I can share the screen with you so that you can see what I'm here. This is what I mean the square root. First, you calculate the expected return, the summation, the accumulation of it, then you subtract from this return, and you just square root of it to get the standard deviation. From in first two questions, you should have done it the same.
Okay, I get it. Sorry.
Okay. Thank you so much. I really appreciate your effort that you have put. That I told you before, the correctness will not be graded. Your participation will be graded for activities.
Right.
And one more thing that I wanted to tell you, there are people who have some problems with the Moodle. They cannot log in, they don't have an access and so on. Please make sure you solve this issue before we get into the quiz and the midterm, because there will not be any excuses accepted for like not having access to the Moodle. Is there anyone in the class now who has a problem with the Moodle access? Because everybody's supposed to get access to the Moodle. Everybody, there is no any like exemptions. Okay, thank you so much, Tenger. And who can help me to solve question 19? Question 3. So for two investment, consider figure 1.2 and 1.2 in the table 2. What are the alternative risk return combination of the correlation 3, 1, and -1?
Okay, Professor.
Yes, I would just wanted to call you and you just raise your hand. Okay, that's great. Yes, please, I'm stopping to sharing. Just share your screen if you want.
Can you see my screen?
Not yet. Just waiting to. Yes, now we can see it. Now we can see it.
So question number 3 is actually from the book, and the question say that refer to the problem figure 1.2 and table 1.2. So when I checked the book, it said that it has standard deviation 16% and 24%. So standard deviation 1 is 16%, standard deviation 2 is 24%, and expected returns 10 and 15%. And the correlation is, this is a book example 0.2, but in our example it says correlation 0.3, 1 and minus 1. So here is the 0.3, 1, minus 1. So, and we have to make a table like we did in our example, like when we have equal weights, when 0, 1, and we go give everything to one investment, when we give everything to another investment. So I distributed with the weights 0, 0, 1, 0.2, 0.8, and so on. And so we calculate expected return. So I copy pasted the formula. So to calculate expected return, here's the formula. So expected return 1 by its weight and plus the other one. So here we have all expected returns, 15, 14, 13, 12, 11, 10. And standard deviation using each correlation 0.3. Here all the correlation, standard deviation correlation equal to 1 and minus 1. Yeah, so the formula is the following. So standard deviation is equal to the everything is square root, square times 2 times correlations multiplied by weight multiplied by standard deviations. So, and we get these numbers. Everything is automated.
Okay. I got it, but I have one more question to you. Which of the proportions would you have selected if you're given 3 different alternatives? Like in the case of 30% of correlation, like 0.3, which weight you would select it?
Probably I would take with this one, the third one, 0.4 and 0.6, because the expected return is like difference with maximum is 2%, but the risk is less, 17% and 24%. So I would go with this one.
Okay. And what about if it's 1?
If it's 1, maybe we can proceed with this one. Oh no, I still would go with this one.
Sure.
Okay, let me see, just risk.
Look, the aim is that to select the lowest risk and highest return.
Right, so the returns are different with 1%. Yeah, maybe this one or this one. Yeah, this one.
17, yes, good. And what about minus 1?
And of course this one.
With the 0 risk.
Yes.
Okay. In reality, actually, it's not possible. Anyway, thank you so much. Thank you so much. I really appreciate it. Okay, let's move. Thank you. You can stop sharing. We have like couple questions left, like last 2 questions. Or if you don't mind, Raj, you can continue with the questions and just, I like your presentation. Go with this 4th question, with the systematic risk. How do you define the systematic and non-systematic risk? Okay, Raj, I think he's not hearing us. He's out of, okay, Raj is not with us now. No, he came back. Okay. Anyone who would like to make some comments on the 4th question here? What is the difference between systematic and non-systematic risk? And which is more important to equity investor? And which can lead to the bankruptcy of the corporation? Maybe Alua, can you just give us, don't share the screen, just share your ideas about the systematic and non-systematic risk. What do you understand from it?
So I think that systematic risk cannot be like diversified. It cannot be controlled, and it's like the risk that the company cannot like take advantage of, cannot manipulate, I would say, because it includes external factors like political or economic. That's what I understood from.
Yes. And could you give us the systematic risk that cannot be controlled?
Like coronavirus, maybe?
Yes, very good. Very good. Very good example. And what about non-systematic risk that can be diversified?
Non-systematic.
Anything that you can ensure that nothing gonna happen. That if it happens, you'll be kind of like, what do you think about the foreign exchange?
We can use futures and forwards.
Forward contracts to kind of protect ourselves against any changes, yes?
Yeah.
Okay, very good. And what do you think about which of these types of risk can lead to the bankruptcy?
Both, probably.
Yes, very good. Very true. Both can lead to bankruptcy. Both can lead to bankruptcy. Thank you so much. Thank you so much. And question 1.6, I think, did I give you 1.6? Yes. The expected return on the market portfolio is 12%, risk-free rate is 6%. And what is the expected return on investment with a better 0.2 and 0.5 and 1.4? Okay, I'm gonna select Bekjan. Are you here?
Yes, I am.
Okay, would it be possible for you to share this question with us?
Yes. Kijk hier.
If you're not comfortable to share, it's okay, Bekjan.
It says that I cannot share the screen because the.
Okay, now, yes, because of me.
Yeah. Which question?
Question 1.6.
Oh, Professor, turns out I didn't do that.
You did, wait, what did you do? 1, 2, 4, 5. Yes?
Yes.
What was the question 5? Wait. No, it's a calculation. You did it.
Did you ask about fifth question or sixth question?
Question number 5. Question number 5.
Okay. If it's 5, then I did it. Yes.
You did it. You did it. I see it.
So this is my formula. Let's simply just put the variables into formula and.
Which formula?
So the one which is the one that was on slide. So I don't remember the formula, but there was a formula which calculates obviously the expected return. But this formula is written here.
Bekjan, the case is that you did something wrong. I mean, the
Yes.
numbers, what you got is 7.8%, 10.5%. And better is, what did you do here? You should have calculated using CAPM, Capital Asset Pricing Model. Did you use this one?
I think so. Well, let me check.
Check it, please.
Okay, so this is the formula. the risk-free rate, better return in the market.
Okay.
Oh, yeah, probably I've used another formula.
You have used something else. You have used something else, because what I saw from your calculation, just open it again. 1 minus 0.2, but 0.2 is
It was better. I used this formula, turns out, like the same which we used in the first. No.
okay. Now do it with the formula which is given in the book. Okay. What
Okay.
is the rate for the risk-free?
Is it 2%?
6%.
6%.
Do you want me to do it now?
Yeah, please. Let's do it all together, because I want to be sure that you did everything correctly.
Okay. So
Risk-free rate. Then
what was the risk-free rate?
6%.
6%.
Thanks, 6%. So, okay, let me just quickly open
You know what is the
the-
best thing? Copy the formula. Risk-free rate plus beta times expected return on market minus risk-free rate. Type it in Excel so that everybody can see it. Type it, risk-free, RF, plus beta times, open the bracket, RM, return on market,
okay, RM.
return on market, minus risk-free, RF. Close the bracket. Okay, just delete this equal sign because it will calculate something to you. Okay, great. Now, using this formula, let's calculate. Our risk-free rate is 6%.
Plus beta.
Beta is 0.2. Open the
Times.
market. What is the market rate?
12%.
So this is what we got here.
Okay, now we can see it. Okay, go ahead.
Next one.
Yes. Just
the
copy this formula above, copy it, and change the beta. Change the beta. Okay, now it's correct. Now it's correct. Now it's correct. Now,
stop.
Don't stop. Don't stop.
Okay.
Don't stop, because I want you to interpret. I want to make some comments on that. Look at the betas. So what does the beta measure?
The systematic risk?
Yes, it measures the riskness, how much the riskness it can be. For any risk that you take, that should be compensated. Systematic risk, that should be compensated. Higher the beta, the more expected return you will receive. You're like expecting to receive it. Look, when it was 0.2, the beta, the expected return is 7.2%. But when the beta jumps to 1.4, your expected return doubles. So the more risk that you're involved in, the more return you are kind of demanding on the risk that you're involved in. Okay, this is the comment that I want to leave on here. And let us move further to the second chapter. Thank you so much, Begzan. I really appreciate. Now, okay. Alternative investments. Okay. Alternative investment is collectively refers to the many asset classes that falls outside of the traditional definitions of stocks and bonds. And these investments are done through the hedge funds, private equity, real estate, commodities, and infrastructure, and other alternative investment primarily kind of called as collectibles. So traditional investments, and we have alternative investment. These terminologies are different. Traditional investments are meant here that you make investment in financial instruments like stocks, bonds, derivative contract, and so on. But alternative investments are done through the hedge funds and the mutual funds. So alternative investment differ from the traditional investment in terms of types of assets and the security they included in this asset class, in terms of the structure of the investment vehicles in which these assets are held, like use of derivatives and the leverages, and they mostly are illiquid assets and short securities, like opposite to the long position securities. So alternative investments are compared to traditional, and they're different from it. Having the active management, they bring you high fees, low level of diversification, narrow manager specialization, and redemption restriction. Other features: low correlation with traditional investment, low level of the regulation, and unique and the legal tax considerations. One thing before I proceed, I would like to ask your idea about what do you know, what does mutual fund mean, and what does hedge fund mean? How do you define them? So far that you have taken many courses related to finance, what did you understand? What does the mutual fund mean? What is the hedge fund means to you? And what is the difference between mutual and the hedge fund? Do you have any idea?
Can I answer the question?
Yes, please.
So as far as I know, hedge fund is a type of mutual fund. But for example, mutual fund is the like it was a investment vehicle where investors put their money into one pool, and then this pool is managed by like some manager, fund manager. Yes, this is mutual fund, and hedge fund like the same kind, but the aim is to generate high returns through having high risks.
Very
This is how I
true. Okay,
understand it.
somehow you're very close. Any ideas? More addition? Anything you want to add more?
Maybe mutual funds is available for everyone who wants, and hedge fund is like they have their higher risk, but they have like very good return rate. So it depends. Like hedge fund is only offered for the like number of investors only.
Hedge fund is available for number of investors. What do you mean by that?
Maybe chosen one. They choose one. I think.
Okay. Any ideas? Any additional information? You are correct. You are very close to the correct differentiation between the hedge fund and the mutual funds.
So in hedge fund, you trade the more liquid assets, and the trades are more complex. As far as I remember.
uh, concerning that one, you're very close. Okay, there is a really good differentiation and very clear differentiation between hedge funds and the mutual funds. Any more additional information, please? Feel free.
So maybe mutual fund is closed-ended and hedge fund is, or vice versa. Mutual fund is open-ended and hedge fund is closed-ended. Meaning that in the hedge funds, as someone previously mentioned, only limited amount of investors can join the hedge fund, while the mutual fund is for unlimited investors.
Okay. 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 Let me then define the definition, but before define it, hedge funds having the private investment vehicle that manages the portfolio of securities and derivatives in partnership. So they do not necessarily hedge the risk in the name they might imply. Okay. They do not hedge it. It's just name implies. So what it means hedge funds in here, both mutual funds and hedge funds, they manage the portfolios. Okay, they invest in portfolios. They don't buy just one stock. They manage a certain number of the stocks, bonds, derivative contracts, and so on. But the main difference between the hedge fund and the mutual fund, the financial information about the performance of hedge funds in contrast to the mutual funds is not available as in mutual funds. Mutual funds, it's publicly available, it's published, it's the first. They are more open. Second, in hedge funds, only sophisticated investors are involved, which means only those investors who has really huge amount of the money. You cannot enter to the hedge fund with $1,000 or 10,000 bucks. There should be a specific amount of the money that should satisfy the interest of the hedge fund to the portfolio. In contrast to the mutual fund. Mutual fund, even if you have $1,000, even $10,000, will let you to go in to the portfolio investment. This is second difference. First, publicly availability. Second, so third, hedge funds, they are always like first takers. First see, first take. And they do not disclose any information. If they could disclose it, they wouldn't have this chance to be a first takers. So they see something very good investment, they try to take it first. And it is available only for certain number of the investors. Let me just correct myself, to sophisticated investors who has really huge amount of money. This is the difference. And their third difference, if I'm not publicly availability, that the hedge funds are more closed. Hedge funds are least regulated in contrast to mutual funds. And hedge funds are mostly dealing with the illiquid assets. Okay, this is the main three differences between hedge funds and the mutual funds. So another types of alternative investment I would like to mention is private equity investment funds. Is the investment in equity of companies that are not publicly traded. In the equity publicly traded firm, that fund intends to take it private. It's another measure. Like there's a publicly traded company, but it wants to go private. Or the companies that are financially distressed companies. Majority of private equity activity involves like leverage buyout. The third types of alternative investment, we call it a real estate, indirectly and directly. So what do you know about real estate, guys? Who can tell me?
What exactly about real estate?
What do you understand by the real estate? Have you heard about the real estate investment?
Yeah, so they gather funds in order to finish or complete the project, the building.
Okay, who is interested in investing in this project in buildings?
People who would like to live in the building, no?
Yes, okay.
Or maybe investors. So basically, they invest money, and they as an output they get the apartments. And
Cengiz, look at here more clearly. I will let you to define it. Residential and commercial properties. What does it tell you?
Private residential where people live. Commercial is like in order to get money from it. I mean, shops, etc., etc.
To rent it, yes?
Yeah, rent it. Yeah.
To rent it. So real estate has been divided into two types. One is residential, the other one the commercial. So the people who buys to live in it, the other one buys to rent it. Thank you so much.
You're welcome.
So other categories of the alternative investment are commodities like physical product, invest in commodity based on business, gold and so on. Infrastructure, direct, indirect, refers to the long-lived assets, like investing in roads, airport, utilities, and schools and hospitals. There are other one like tangible collectible assets like fine wines, the stamps, automobiles, antique furniture, and so on. In 1926, there was one whiskey was bought for $1.05 million. I don't remember the name of that whiskey, but one hedge fund was involved in that in US. They bought one wine for $1.05 million of dollars. So in these days, they still happen like hedge funds. They're involved in buying and selling these collectible assets, tangible collectible assets like stamps and automobiles and so on. So benefit of alternative investments, they have low correlations, which shows that any changes in the markets will have a less effect on the portfolio and will have a really good return. Tax benefits, you get some really good tax benefit. It's less taxable in contrast to the traditional investment. There is a return premium for illiquidity. As I told you, alternative investment as itself, in contrast to the traditional investment, are less liquid. And for that less illiquidity, the investors, they get premium. So uses of leverage is another alternative because it's easy to get the leverage, like especially in the real estate. Even some companies, they provide the leverages for their properties. And of course, lower risk in contrast to traditional investment. So alternative investment has got some unique characteristics that has been categorized into four, like different strategies, free structures, and issues in due diligence. And issues in valuing and calculating return. So we're gonna talk separately about each. So let us start with the hedge funds more in details. Hedge funds are more flexible in contrast to mutual funds that we have already mentioned. They're less regulated and less regulated if you compare to the mutual fund, and can be highly leveraged. Short equity positions, they short or long position in derivatives, and only the sophisticated investors with adequate wealth and sufficient liquidity. And the fee is based on managed value of the assets and the fund returns, not on the performance of the hedge fund itself, in contrast to the mutual fund. Hedge funds are less liquid, as we said before, to traditional. Actually, all alternative investment types are less liquid. And restriction on redemption includes lockup periods, a notice of like 30 to 90 days redemption request days. So does anyone know what does the redemption mean? Does anyone remember from finance courses? Okay, redemption. Everybody is familiar what is the bond value, yes? What is the bond and how the bond works?
Yeah.
Yes. So we have face value, which is basically $1,000 or 10,000 euro or something else. We have coupon rate, which is 7%, just making up. We have ITM, which is 10%. And we have book value or some, that's it. This information is given to you. So, and your coupon payment is $70. So this is what we know. And maturity is, let's say, 10 years. Okay. Any investor who buys this bond, he or she entitled to receive 7% of the coupon rate. Plus, at the end, whatever he gets, he will receive his face value, redemption value. Okay. That means he will get this money back. After when? After 10 years. So this $1,000 face value that he is promised to receive it, apart from this 1,000, he will receive 7% of this face value. So this is called a redemption value. Sometimes this redemption amount can be requested before the maturity if the condition is provided below, like callable bonds or something when the bond is called, or something redemptible bond that investor in the bond or bondholder can have a right to redeem the money back at any time he wants. So if this condition is written down, and he may have the money back. So he says, I want to redeem my money in 5 years, not waiting 10 years, okay? So whatever the money you invested, he calls back the money. In here, in hedge funds, this thing that I was trying to remember, in contrast to the mutual funds, there is a restriction on redemption. You cannot redeem the money anytime you want. In contrast to the mutual funds, it's more restricted. So whatever the money you invested, you invested. So if you want to get money back, you have to at least tell them within the period of 30 to 90 days, like which is called redemption request days. Extra fees on redemptions. It covers the transaction cost for managers of the hedge funds. So if you want to redeem the money back before the priority day, it comes unexpectedly. Then you have to pay some fees on that for urgent or early request on money. Fund of funds gives you opportunity for smaller investors to invest in diversified portfolio in hedge funds. So there's a hedge fund kind of created in hedge fund is created a certain portfolio for small investors. So there will be some additional fee beyond the main fee for which is given for the performance of the assets. So there are mainly 4 strategies which is used here. Event-driven strategies in hedge funds, these 4 strategies. And guys, I want to stop here because my throat is really giving me ache. I cannot continue because I did not cover fully. Take my apologies, please. And we'll stop here. Wednesday, I will continue. We'll complete this chapter Wednesday.
All right.
Okay,
Get well
get
soon,
well soon.
brother.
Okay.
Thank you
good
so
luck.
much
Thank
for
you,
your
fast
understanding.
recovery.
Thank you so much.
Bye bye.
Bye, Professor.
Bye.
Bye.